Global CFO. Kiran will start the call with the update of the quarter, followed by Arun, who will give the financial updates, which will then be followed by the Q&A session. As usual, I would like to remind you that everything that is said on this call that reflects any outlook for the future or which can be construed as a forward-looking statement must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we mentioned in the prospectus filed with SEBI and subsequent annual reports that you can find on our website. Having said that, I would like to hand over the call to Viral. Viral, over to you.
Thanks, Damini, and good day, good evening to everybody. Thanks for joining the call, and hope everybody is staying safe and all your families are keeping safe. My name is Hiral Chandrana. I'm the Global CEO. I would like to focus on four things in my discussion, and we'll hand it over to Arun to provide more details on the financial performance as well. The first topic is giving you a few highlights on key metrics. The second is around the business updates and outlook, around people and talent. And I'd like to end with strategic vision and our progress on that as we get ready for another fiscal year. Coming to the financial highlights, you would have seen the results and some of the key metrics, but I want to highlight two or three things very quickly. And Arun will cover it in a lot more detail, but the revenue performance year-on-year was 24.6%. We had a quarter-on-quarter growth which was slightly lower, but the 9 months put together for this fiscal year compared to the last 9 months from the last fiscal year, our year-on-year growth was almost greater than 29%. Our order book performance was the highlight of the quarter. We actually had tremendous deal momentum. We had alluded to this in the last call in October as well, where I had given indication of some large deals as well as mid-sized deals that we've been working on. And that is reflected in the 12-month order backlog as well as in the order book performance, which again is greater than 34% year-on-year. A lot more deals on the pipeline. We continue to see good traction, and I'll cover that in a bit in the business commentary. Operating EBITDA, we've been able to maintain in spite of talent costs and various other investments. 21.1%, and we have communicated that in the past as well in terms of our rigor of managing the business. But again, Arun will cover more details on each of those metrics. What I do want to highlight in the as part of the performance is this is one of our quarters that we've had. One of the areas that we did focus on significantly was recruiting and then of course retention. And we'll cover that in the people and the talent part, but our engine is now firing to cater to the demand that we're seeing in the market. And we will continue to focus on recruiting and retention being the key priority for the coming quarters. The other element which is part of our results as well is our ability to now engage with larger clients and Fortune 1000 customers. I had mentioned this in the past call as well, but we've added, even in Q3, 7 new Fortune 1000 clients, which is reflected in our results, as well as a lot more discussions in the pipeline. So we're feeling a lot more confident of large customers engaging us in strategic discussions around their digital and cloud journey. And our ability to not just interact in strategic conversations, but close larger deals with them as well. That's a summary of the highlights on the financial metrics, and let me go on to the business commentary and give you a flavor of specific areas that we are focused on. In October, when we had spoken, there were 3 or 4 things we had communicated. One is around the deals and the large deals that were there in the pipeline. The second was around our co-sell strategy, combining the power of Oracle Cloud and our digital services to create more integrated deals. Number 3 was obviously our focus on strategic bets, which included data automation and focus on healthcare and life sciences. So in that context, let me start with UK. And, we are very excited about the largest deal that Mastek has closed in the history of our this has been communicated in the public forums. I had alluded again to it in our October call, but we could not declare it officially. We have now officially communicated that it is a greater than $60 million deal over 4 years. And more importantly, it's a very strategic impact to the UK's public infrastructure and healthcare IT at the national level. When patients go through different implants and medical devices, there's always reactions and after effects. And our solution that we are designing, developing, and operating for NHS is actually going to create a data intelligence infrastructure to manage that and provide real-time information so that those after effects can be managed. And NHS is very excited about this. So is the entire UK government. As well as we've seen much more uptick in NHS itself on a few other areas, which we will announce in the next quarter. But there are deals that we have won in January as well. I mentioned NHS specifically because we had, again, very transparently communicated that we had seen a dip in the NHS revenue in Q2, and that had effects in Q3 as well. But now we feel confident with the order book and the momentum that we should be able to get that back on a uptick starting this quarter, which is in Q4. Moving on to our business in the Oracle Cloud space. As you know, this has been one of the areas we've continued to grow, actually across all geographies. However, I'm very proud to say that our North America, US business, when it comes to Oracle Cloud, had a really solid order booking quarter. And this is important as we continue to focus on America for exponential growth. There are deals that we have won in North America, which included large managed services deals. And when we say managed services, we are differentiating in the market with our cloud and SaaS-based managed services model, as well as integrated deals in that area. We also had 2-3 marquee logos in North America related to Oracle Cloud. One of them was a large trucking and logistics company, which is a fresh implementation of a multi-tower Oracle Cloud, and also significant more potential in the digital services in that organization. We also built on one of the successful implementation and go-lives at a healthcare group. It is a provider to local healthcare agencies and hospitals. And this is another strategic win because we implemented Oracle Cloud in that organization. And now we have won the follow-on managed services deal with that same organization. So this is an example of how we are building on not just implementations, but also downstream work in post-our implementation. Moving on to our digital services business in the US, there has been significant traction around D2X and our digital commerce space. As you know, the October, November, December quarter is a very heavy holiday season quarter. It has a seasonality effect for us because of holidays, but it also is a very critical period for our retail and e-commerce customers. There has been about 8 or 9 significant go-lives, but also more importantly, we are playing a role in not just supporting e-commerce sites, but helping our clients increase their revenue, increase their orders and transactions, as well as looking at how they can improve conversions and attract more guests in their websites. So this is particularly exciting because as more and more organizations, not just in the retail space, but also in manufacturing and other industries, move their business online, we have the experience and credibility to scale and make business impact and business outcomes for them. There is one particular deal that I want to mention in the Americas, which is again an integrated deal. This, when I say integrated deal, we have combined the power of our digital front office as well as our Oracle Cloud back office, along with some digital development in the API and microservices world. So this particular deal is with a marketing and media company where we are going to do an entire lead-to-cash transformation from front office to back office, which includes not just Oracle, but includes Salesforce and other technologies as well. This is particularly exciting because this, again, demonstrates the combined power of our Eversys acquisition and how we are incorporating that into every deal. Hopefully that gives a flavor for some of the deals that we have won. There is more details on other wins we've had across UK, Middle East, as well as Americas. We announced this week that we have opened a center in Romania. This is a strategic move as well, as we continue to see traction in the Europe segment, particularly in Nordics and Netherlands. And this will provide us the ability to cater to languages as well as grow in the Europe market in the future. All in all, business across geographies and segments was on the uptick in our order booking. We did have seasonality, as I mentioned, and furloughs, obviously currency impact from a UK perspective. But we are looking forward with confidence given the demand and the pipeline that we have across all those geographies. Coming on to a very strategic topic on people and talent. There is definitely challenges around the industry, as you know, on attrition. And we have communicated that we are engaged in about 5 to 7 very strategic initiatives around talent. And this goes all the way from employee people experience to skill transformation to different ways in attracting talent. We have started to release an update on our brand positioning. You'll see more of that in the coming weeks. But employer brand and our positioning in the market is equally important from an employee perspective. And we are focused on our employee value proposition as well as talent, and that is paying off. Where we are able to provide differentiated work and faster career growth and path. And we're seeing that in our ability to attract talent. This quarter, which is the Q3, was one of our best quarters when it comes to number of people and the hiring and the onboarding. Most companies are doing that, but we have ramped up on our fresher hiring, as well as our combination of fresher and lateral hiring is going to position us in Q4 and beyond. We are taking steps to manage the attrition and retention while improving our ability to increase our recruiting to cater to the demand that I mentioned earlier. There are 2 executive leaders that we have hired among many other leaders who have joined Mastek in Q3. Across the board, we've gotten some interesting talent from the industry. These are from large companies and even in some cases from leading-edge startups that we are able to attract into Mastek. And the head of marketing and partnerships has joined us. She came from Capgemini. We're also going to be announcing that we've hired a head of innovation and technology. And this will chart our ambition of creating non-linear platforms and differentiated growth going into the next 3 years. Let me move on quickly to our strategic vision and progress around that, and then I'll hand it over to Arun. We have indicated a few big bets, and I'll just cover them very quickly. Happy to answer any questions around that in our Q&A. But our strategic priorities have been under 4 and 4+1, I'll say, big blocks. The first one is around the Americas geography. And hopefully you're seeing that uptick in momentum, but we are particularly excited about the pipeline as well as on the order book side. Like I mentioned, we expect that to continue to grow in this quarter and beyond. The second is around data and automation. Again, you'll see that reflected in our results. We've been able to significantly increase our share in the data and automation space. I think this is going to be important as we look at the next 3 years. We believe that this era is going to be in the data pipeline and how data is going to move into the cloud. So as Mastek is mostly a digital and cloud business, we have the unique ability to focus on this area and also take a head start, not just within organically, but even potentially through partnerships and inorganic means. Our healthcare focus that we have communicated in the last couple of calls is now starting to pay off. We are hyper-focused on this industry cluster because we do see the demand, but also we have certain solutions and differentiators that we are able to win across geographies, not just NHS, but even in Americas as well as in Middle East. Our innovation focus is going to be critical, but our ability to partner has significantly increased. In addition to Oracle Cloud, where we are dominating the partnership, we are the only company that has been listed as part of our Evisys umbrella, where it is the only company that is listed in the Oracle website as an organization that competes with SAP. This is important because of our focus, where Oracle is able to bring us into deals proactively, and it is helping now create larger deals as well in the upper mid-market and even in the Fortune 1000 space. The last point I'll say is again on talent and people. I cannot stress on this enough. I'm very pleased with the change that we had made in the previous quarter, where we integrated all our recruiting elements together into one function called Global Workforce Management, and that is starting to pay off. We'll see that in the Q4 hiring as well, where we look at significant number of freshers as well as laterals as we grow, for the next 3 years. But more importantly, we are differentiating when it comes to employee experience as well. And that is important from a talent attraction, but also from a talent retention perspective. We have also been focusing on one more strategic area at a corporate level, which is ESG. We also have plans to announce certain things and be listed on the Dow Sustainability Index, and you'll see that in the next quarter announcement. But I wanted to give you that heads up because as it relates to environment, sustainability, social values, governance, you've always known Mastek to lead the way, and we continue to do that in addition to our work with, on the social and the foundation side. With that, to wrap up my session, I think, again, on the financial metrics side, on the business commentary, as well as the people and talent and the strategic vision, in that context, we are confident about the growth in Q4 as well as going forward for the next 3 years as we execute on our strategic plan. I'm going to hand it over to our CFO, Global CFO, Arun Agarwal. Thank you.
Thanks, Siddharth. Quite a comprehensive summary. Gives a 360-degree view in terms of different initiatives which company is driving. A very warm welcome to everyone on the call. Q3 was another quarter of our consistent financial performance. We are seeing positive order book momentum, as mentioned by Hiral, in our key markets, UK and US, followed by Europe. In our key verticals, government and healthcare and life sciences, and in our focused service line, data automation and AI, together with Oracle Cloud and Enterprise Apps, while others continue to deliver on expected lines. Revenue for the quarter was $73.6 million, reflecting growth of 3.7% quarter-on-quarter and 20.9% year-on-year in constant currency terms. In INR terms, it was 551.9 crores, up by 3.4% quarter-on-quarter and 24.6% year-on-year. Operating margin for the company stood at 21.1% for the quarter, flat when you compare to quarter 2. I would like to stress and give a perspective. While we continue to invest in talent retention, hiring and training the freshers, and continue to hire laterals given current attrition scenario, we have been able to maintain healthy operating EBITDA margin on the back of operating levers and SG&A reallocations, an initiative which Mastek is running from last 4 years to ensure we deliver the quality of earning. As I mentioned about the healthy momentum in order book, the same has been reflected into our 12-month order backlog. We closed the quarter with $171 million, reflecting 9.9% increase quarter-on-quarter and 33.7% increase year-on-year in constant currency terms. Our PAT stood at 83.5 crores, up 2.4% quarter-on-quarter and 18.7% year-on-year. Coming very closing to certain balance sheet items, closing cash was 932.3 crores versus 943.9 crores in the previous quarter. Just to highlight, during the quarter, we have discharged part consideration for CCPS buyout to the tune of 29 crores. We have also paid for FY21 final dividend in the current quarter, which was in the range of 27 crores. So discharged one installment of loan in the UK, which was coming up for on a timely installment terms, has been paid in the current quarter. Our free cash flow was 77.2% of net income for the period 9 months ended December 2021. During the quarter, we have added 25 new customers, and most important, 7 of which have revenue, their revenue in greater than 1 billion in size, which again creates multiple options as Hiral alluded to, whereby we can go and do a lot of cross-selling, co-selling, because they come with very high IT wallet in terms of spend. Our average deal sizes are increasing as we are participating in more multi-million and multi-year dollar deals on the basis of comprehensive and integrated solutioning, including Oracle Cloud and Mastek Digital Services. Our closing headcount for the quarter was 4785, reflecting net addition of 275 resources during the quarter. Very quickly reflecting on the geography performance, our UK and Europe business grew 2.3% quarter on quarter, despite furlough and seasonal impact. While public sector and healthcare continue to grow quarter on quarter in UK, we saw reduction in private sector revenue led by fewer project completions and go live, and further impacted by seasonal leaves and the furlough. As Hiral alluded to, during the quarter, we have secured one of the highest order, $60 million plus from the NHS. And just to highlight, and we go back to our last 12 months of conversation, we had been onboarded by NHS as one of the 12 service providers under 800 million framework. This is the example of the deal which is coming out of that framework. We believe many more to come, and this was the size we were looking for, as we mentioned in the last quarter call, and quite happy to announce finally we have got it. In terms of UK geography, our year-on-year growth was 23.8%. Moving quickly to US as a geography, our quarter-on-quarter growth was 5.1%, coupled with strong order book in healthcare and other verticals across Oracle and digital services. As Hiral mentioned, it is one of our biggest quarter in terms of order book in North America region for Oracle Cloud business. Year-on-year growth in the US was 30.7% during the quarter. EMEA grew 6.6% quarter-on-quarter and 21.2% year-on-year, led by strong execution. Oracle and enterprise apps continue to grow healthy, led by cloud transformation and managed service engagement. And I would like to highlight, we have reshaped some of our offerings. We have coined a terminology called Application Enhancement Services, AES we call it internally. We are winning multi-million dollar and multi-year engagement under this offering. And the uniqueness of this offering is it's created on the base of value-based delivery, quite similar to what we are doing under implementation services. What it does to customers, through automation, we are reducing the number of incidences which is coming for the kind of error situation or different not so comfortable situation for the user. As we bring those incidents down, more time can be spent in terms of enhancement of services, and hence clients see better return on their investment. And at the same time, as we are spending more time in terms of automation, it's opening up new business opportunity as we are getting into data automation and AI relating to the cloud offering and services. Just to end the conversation, there are 2 more call-outs very quick. One, we have declared interim dividend of rupees 7 per share, which is 140% of our face value of share price. Also, as Hiral alluded to, we have opened our nearshore center in Romania to accelerate our expansion in continental Europe and also support as a nearshore center for UK and other markets. Thank you everyone for your time and the opportunity and your continued trust and support to Mastek. Let me hand over the mic back to the moderator and open the house for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Baidik Sarkar from Unifi Capital. Please go ahead.
Gentlemen, in the context of the environment, I guess one expected much better numbers. So this is a bit underwhelming. I have more than a few questions, so let's just stay with this until we're done. I'll go practice line-wise. Hiral, the digital commerce and experience vertical, I'm assuming, is largely US-led. and it's back in the degrowth territory. If I could request for a frank assessment of what exactly is happening in the US market now. I understand the right to win might be limited, might be constrained by our size, and we've been making investments in leadership to that extent for several years now. How should we realistically imagine this vertical? And let's not address this with the blue sky scenario because we know how attractive the blue sky is. Please give us a realistic assessment of how we should imagine this, the risks to execution, and why you feel this will break out, or if at all you think it will. And I repeat, no macros.
So thanks for the question, Vivek. I was able to hear you fine, but your voice was a little bit unclear, although I did get the gist of the question. So let me answer it, and then you can clarify if there's certain things that were not answered. Again, I think it was just a combination of the digital commerce experience in the US in the context of Americas. So there is 2 or 3 things when it comes to the whole digital commerce and experience space. One is the specific commerce itself, right, where we do a lot of business managing as well as developing and operating websites and helping our customers grow in the online space. There is also certain elements of imagining their customer journey as it relates to front office transformation. So this includes sales, services, marketing. And then Oracle also has a CX component of the business, which is what they call Oracle CX, which is now integrated in their portfolio, which includes CPQ and CRM from an Oracle perspective. So when we reclassified this particular line item on the Oracle, on the digital commerce and experience side, it includes the Oracle components as well. So that's point number 1. The commerce and experience parts of Oracle, I'm referring to. In that context, the majority of the customers that we've had in the past have been retail and consumer type of customers. This is, again, going back over the last couple of years. But what is happening now is the same experience of B2C and the same movement of e-commerce transformation is getting applied to other industries as well. It could be manufacturing industries, it could be even financial industries or healthcare industries. And this is where we have coined a differentiated approach and framework called D2X, which is direct to stakeholder. And this is giving us the ability not just to look at direct to consumer, but direct to supplier, direct to partner, direct to any other stakeholder that a customer deals with. So this is just the business framework in which we're operating that. Americas, when we look at this particular practice and this particular service line, we have started to win deals in Australia, in Middle East, as well as in UK. So it is no longer just a purely America's business. So that's point number 1. Point number 2 is now we are able to take that element of front office, which is combined with all the things I talked about, and have integrated approaches where we can combine CX, digital commerce, as well as back office. The example of the deal I gave earlier on the marketing and advertising media company is actually combining Salesforce as well as Oracle back office. So this is how we look at it. There is going to be December is going to be a challenging quarter for this business in particular because of the holiday season, as well as there is no new development that typically customers do in November and December, and this is pretty standard across the industry. I've seen this in the last 15 years. And the reason for that is the focus is really to, on the sales, to execute the orders, to look at transactions, to improve the volumes. So you'll see a little bit of a challenge when it comes to this particular line item in Q3. But this is a business that we are very confident that will continue to grow on an absolute basis. So hopefully that answered the question.
Thank you. The next question is from the line of Debashish Mazumdar from B&K Securities. Please go ahead.
Hi, good evening, everybody. Thank you very much for taking my question. So this is a continuation of a question I asked in the last quarter call also. If I see and connect the dots of the fact sheet numbers that you have announced, it is very clear that we have certain amount of lesser growth or degrowth we are seeing in the private customers in the Europe market. And this, in the context I'm asking because all of our larger peers become very, very active in Europe market. So is it like, are we losing certain amount of market share with the private players in the Europe market? Because if I see across segments, whether that is retail, manufacturing, energy, services, everywhere we have reported degrowth, and government has comparatively done well for us. So I'm assuming that Europe private segment has not done well for us in this quarter. So are you seeing any trend here? Is it a one-time place which is expected to come back in next few quarters? And how do you want to see it?
Sure, Devashish. I think it's a good question. Let me divide it in two parts. Yes, when it comes to Q3, the private sector revenue on just a pure number basis had a challenge and degrew, but that was something that we expected going into Q3. Part of it is, of course, furloughs and the seasonality, but part of it is few projects getting completed as well. Now, having said that, this is an important part of our strategy, and obviously we want to show this and execute on the promise when it comes to private sector. But we are still taking a focused approach here. We are not going to go into too many different verticals when it comes to private sector in the UK market. Our focus has been on the microfinance and the financial services components, or part of the financial services vertical. We've also focused on retail and consumer sectors in the UK. And we're starting to see a little bit traction in one or two other verticals. But if I look at going forward in terms of private, this is definitely not a pattern. We do have good pipeline and actually some good traction building in the verticals I mentioned about. In fact, we're expecting a very healthy order book. Three of the medium-sized deals that we were expecting to close this current quarter, this is Q4, we've actually closed two of them already in the UK private sector. So it's definitely not a pattern. Having said that, we have a low base out there, and we do have to create a stronger value proposition so that we can go into the larger segment and deals. And that's the reason for our very focused approach. Because we believe if we are able to differentiate in certain verticals and certain value propositions, we'll be able to scale up eventually. A couple of the other comments I made around managed services, around integrated deals applies to that sector as well. And we're starting to see now pipeline with integrated deals where we are able to cross-sell into accounts where we've had Oracle or vice versa, where we've had certain digital engineering work and we're able to cross-sell Oracle Cloud. So hopefully you'll see more there on the private sector in UK. The results right now don't demonstrate that, but we don't see that as a pattern, and there's definitely it's part of our 3-year strategy in terms of the growth engine.
Okay. One related extension to this. We recently had a leadership change, not recent, I mean it's become more than 1 year now. Leadership change in the Europe market, and then you also joined as a new leader in the company. So is there any change in strategy in the Europe market that is affecting our short-term performance and that will turn back? Is it something linked to that?
So Devashish, I think we communicated this last time. The main reason for the dip was one particular account where the wins and the new deals that we were able to close was not fast enough in time to really balance out the ramp downs and the projects that were completed in NHS, right? And we were very transparent on that even in the last quarter call. Yeah. So Abhishek, who joined the UK, actually is physically located to the UK region 4 months back, is doing a fantastic job. Actually, he's rallied the teams very well, taking a much more strategic and integrated approach. And that's what's reflecting in some of these wins and order book as well. So, we don't see any kind of leadership challenges. In fact, we're very happy with how UK has come back strongly in Q3 from an order book momentum perspective, and we see that reflecting in revenue growth in the coming quarters as well.
No, I was not alluding to leadership challenge. I was trying to understand that whether there is any strategic call that you have taken in leaving few clients or leaving few deals because of lesser profitability or something. That is what I'm trying to understand. It is not the leadership challenge.
Yeah, there is no strategic change in terms of defocusing on what we have, because we are actually already very focused in UK, right? We're focused on public sector, we're focused on NHS, and we're focused on certain verticals in the private sector. The strategic call is on two areas. One is the traction that we are seeing in the Europe market, which is outside of UK. We're starting to see some good momentum where Oracle is getting us in there, and so we are evaluating that market more holistically before in a bigger way. So that is point. Point number two is we are looking selectively at accounts in the Middle East, right? Given our ability now to get into Fortune 1000 customers and larger clients across the board, on some of the smaller clients and the smaller deals. And by design, we've looked at that, particularly in Middle East, not UK, particularly in Middle East, where we want to focus on lesser number of clients, but more higher quality revenue, because we are seeing our ability to increase the deal size as well as engage with other customers. So other than that, there is no major change in UK strategy.
Excellent. One last question around attrition. Although on a LTM basis, attrition has gone up, that is visible. But do you see actual number of people churning is coming down or stabilizing at a certain point, so that in percentage term it's still going to reflect in next 2-3 quarters down the line? Are you seeing that trend happening?
Yeah. So I'm glad you brought that up. We should have probably covered that. But Devashish, the quarter-on-quarter attrition has actually stabilized for us. In fact, it was flat. And this is an important part of our retention and an experience focus when it comes to employees, because while the last 12 months, like you said, has increased, but if you look at it from a Q2 to Q3 perspective, that has been flat and stabilized. So we do see that coming under some level of control and hopefully reducing, after Q1 onwards. But the talent market is hot, as you know, and we continue to do everything possible to focus on retention.
Great. Thank you very much for answering my question, and congratulations with a very strong order book addition and deal addition that you have done in this quarter.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in conference, please limit a question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is from the line of Madhu Babu from Canara HSBC. Please go ahead.
Sir, based on this new NHS deal, so should we have a good 4Q? Because last 2 quarters have been soft. So should we be back to 6-7% kind of quarter-on-quarter growth in 4Q?
Yeah, I mean, as you know, Madhu, we don't guide right now when it comes to quarter-on-quarter or revenue numbers, but we're confident about delivering numbers in that range, given that order book has been strong across geographies, as well as some of the dips that we experienced in Q2 and Q3 are now behind us. So, there's always risks in the business, but as it stands today, Q4 is definitely looking much better.
And sir, with this referral in NHS, it's such a large deal, so are we in advanced stages with any other large departments in UK government? We deal with multiple other departments in UK, right? And so are we in advanced stages with any other, in terms of getting any large deal there? Thanks.
Yeah, sure. So while we focus on NHS, but there is definitely some significant momentum when it comes to our engagement with the Army, when it comes with our engagement with some of the existing immigration and other offices that we deal with. There is also the vehicle certification agency that we have won some deals, and there are some city councils on the government side that we also won some deals. So there is one new department and institution that we've engaged in. We believe that that could be a pretty big game changer in the coming fiscal year if we are able to grow in that account. So we're still scratching the surface when it comes to our penetration in some of these larger spends. So we do want to focus on mining and growing some of the existing accounts that we have. But yes, there is 2 or 3 new institutions that we have won, which definitely present us the opportunity to grow in the future.
Okay, so thank you.
Thank you. The next question is from the line of Manoj Baheti from Carnelian Capital. Please go ahead.
Hi, good evening to you and to entire Mastek team. First of all, let me congratulate you for good set of number and good deal wins. So I have couple of questions. First one is, if I look at your disclosure in the press release, like if you have added around 25 new clients, but your active clients vis-a-vis last quarter is down from 447 to 421. And secondly, despite of 60 million win large deals, your 12 months order backlog, it has gone up from 155 million to 171 million. So how do I read these 2 things here?
Sure. So let me start, and then I'll have Arun also add in. There are 2 parts ending to that question. So what if you look at our kind of overall client mix relative to many of our competitors in the same sort of segment or even slightly larger companies, the number of clients that we have is actually significantly higher, right? Now, this has certain advantages, and that's a different part of the strategy that we're going to execute on how we cater to those clients. But there is also, our ability to move into the upper mid-market and Fortune 1000 customers that is paying off. So we do believe that there is an advantage in focusing on lesser number of clients as a whole, and particularly in certain geographies like Middle East, where we believe there's opportunities in some of the existing customers. We don't have to necessarily go after every single client or every single deal. So you're seeing that reflect in the new clients and the active clients as well, where if there is a project or a small engagement with a client that is small in size, we have not put our efforts into renewing anything there. Instead, we're focusing on some of the larger deals and larger clients, right? So that is the answer to the first part of the question. Arun, you want to quickly comment on the order book, and then I can add if you want.
Very, very quickly. So Manoj, interesting point. But to rehash, if you're referring to $60 million deal, that is the 4-year deal, which we have received. Our focus is more in terms of getting long-term multi-million-dollar contracts, which keeps better visibility in terms of revenue profile as we get into. And as we are getting, as Viral alluded to, as we are getting into large value deals with upper mid-market or Fortune 1000 customers, that's the profile which we are targeting. However, what it does, the whole order book may not reflect in 12 months number because they're long tail to execute. I hope that helps, Manoj.
Okay, so it is next 12 months order backlog, right?
Yes.
Okay. So it won't include entire 60 million, right?
Absolutely, got it right.
Got it. So, my second question is, if I look at the attrition and looking at the kind of talent war which industry is facing, so are you also likely to see some kind of margin pressure, or you are able to pass through the incremental cost to the client? So if you can give some perspective on that. Thank you.
So maybe
go ahead, Arun.
Let me take it. Yeah. So Manoj, pretty nice question again. We are seeing there's a good churn, good attrition which is happening. We are investing into talent, hiring freshers, training them. We are hiring laterals as well. The wage curve is going up. But again, in terms of price increase, there are 2 factors which will happen in a short to medium term. You will be able to pass on certain price increase, and some of the price increase you need to bear at the company level. However, we believe our margin profile, currently we are in the range of 21% operating EBITDA. There could be downside, but we are not expecting any significant reduction in the margin profile in the medium term. However, the whole approach is how can we keep working on the operating levers, keep supporting the operating levers to give better margin improvement, which we can reinvest, one for your wage hike and second for the purpose of the investment which we need to drive to grow better than the industry. So it's a combination which we are working on, Manoj, and we believe not a significant erosion which we expect in medium term at least.
Great. Thanks for taking my question. I wish you good luck.
Thank you.
Thank you. The next question is from the line of Romil Jain from Electrum Portfolio Managers. Please go ahead.
Hello. So can you hear me?
Yes, we can hear you. Please.
Thanks for the opportunity, sir. So one question is just want to understand, because we are in many geographies, Europe, UK, as well as US now. So any major geographical, margin differentiation that we have or across, or it would be in the similar band?
Again, Romit, margin profile. See, again, in the developed market, the margin profiles are much better if you get into UK, US, even Europe. And depending upon the nature of services which you deliver and which Mastek specifically in the digital transformation space where we operate, we have quite better range of margin. However, if you get into Middle East or APAC kind of a region, you might feel the quality of thing is not that great. But if you ask me UK, US, and Europe, they would be quite pretty similar. And the customers care for quality of service and not worried with the right price. So we don't see that much of challenge in the developed market.
Okay. I want to make one more comment on that. Part of our strategy to focus on higher quality revenue and lesser number of accounts in Middle East is also connected to that point. So if you look at that as a whole, it should help us not just have larger customers, but better margins eventually in Middle East as well.
Okay, got it. Secondly, on the the other expenses that we have, so I think they are in the range of 29-30% right now. And so, do we see any lever going ahead? Maybe not in 1 quarter or 2 quarters, but going ahead, we can play around and try to reduce that.
Romit, I missed out. When did you say 29-30%?
Yeah, the other expenses, the other expenses which are there, so around 29 to 30% of revenue. Any levers that we can reduce those in future?
Yeah, Romit. So there are multiple aspects. Let me give you one very quick margin improvement lever which we keep working internally. Typically, those subcontractors and the contractors which you hire in the overseas market and some in the local market as well gets recorded under other expenses as a line. One of the levers which we work as a management holistically is to convert those subcontractors into employees, and therefore you can reduce the cost. However, the cost is stepped from other expenses to the salary, but yes, the margin profile will improve. But again, it's a little medium-term journey, Romit, to be honest, because at the moment we are seeing significant requirement for the talent. And therefore, whether you get as an employee or you get as a subcontractor, the important point is you should be able to serve your customers, and so that customer is happy and you can keep growing the revenue. So that's more of a mid-term to little year-to-year strategy to keep converting, reducing your other cost and offsetting that the same with the employee cost.
So acquisitions, that we were planning, have we on something, maybe a couple of them? Any updates?
So let me take that and you can add. So we have actually now formed a cross-functional team to focus on M&A. We're also seeing this as a continuum from a build, buy, and partner perspective. And when I say that, there are certain areas that we are going to organically create and build or strengthen. There are certain places where we will partner with the broader ecosystem, and there are certain areas that we will acquire. And we've been, transparent on those areas as well. It will be around CX and customer engagement. It will be around our cloud platform strategy as well as the data and intelligent automation. space, around few leading platforms, particularly with focus on healthcare and life sciences and a few other verticals. So we've scanned multiple assets over the last 3-4 months. We continue to have detailed discussions on some of them. We're hopeful that in the next couple of months we'll get into some level of maturity with it's taken a little bit longer than we expected. There is a lot of good, the market is good, the valuations are high, but we've been able to narrow it down to a focused set of targets, and it's a journey. It's not going to be a one-time journey. This is part of our strategy for the next 3 years as well, where we will be very selective and focused when it comes to M&A. Hearing more in the next quarter on this.
Thank you. Before we move to the next question, I'd like to remind our participants to limit your question to 2 per participant. If time permits, you may join the queue for follow-up. The next question is on the line of Sunil Kothari from Unique PMS. Please go ahead.
Hi, thanks for the opportunity. Sir, compared to last 2 years, I think slowly it seems that investor is feeling that we are losing some momentum. So looking at your objective, which we elaborated in last annual report of achieving some numbers by another 3 years and 6 and 7 years, what are the hurdles which you would like to overcome to enhance and build again the confidence of the investor community? Because if you look at last quarter's number, this quarter's number, on the numbers, people always are getting disappointed because of maybe little bit higher expectation or compared to other industry peers, the way they are performing. So my question is, what are the challenges you would like to overcome in maybe near term and medium term to enhance and build again this confidence? And second question is, looking at the demand scenario, looking at the cost which is going up of the employees and this high attrition, do you see any pricing power coming back to industry maybe in a medium term? These are my 2 questions.
Okay. Sunil, I was able to hear, it was not fully clear, but I got the gist of the questions, and Arun, I can start if you want, and you feel free to add. See, as we look at the next 2-3 years, you mentioned about the broader ambition from our annual report as well as our overall 2025-2026 type of vision. There is a few levers and a few strategic pillars that we've been focused on, right? And we'll continue to build on that and continue to communicate very transparently and progress around that. I think capabilities and service offering is something that we have very closely looked at. There is a lot of good history and track record of very strong delivery at Mastek. And we believe that that's an advantage that we have not leveraged enough. We have some really high impact business value stories that we plan to get to the market, and very excited about a new marketing leader coming on board officially so that we can take that forward. But as it comes to the service offering, we have now created what we call as level 3, level 4 value propositions, which can truly differentiate when it comes to customer engagements in competitive scenarios, right? As you know, given our differentiate when it comes to deals, particularly the larger deals. And so this was one challenge that we saw, and we have been working on strengthening the capabilities and making it much more next generation, so that we can compete not just in addressing the challenge of customers today, but also how they can get transformed tomorrow, right? Because most of our customer base is moving to the cloud. So when we say managed services, we actually don't talk about on-premise managed services as much. We actually talk about the SaaS and the cloud-based managed services. Our ability to take or accelerate their transformation in the cloud, particularly with their digital cloud landscape. So we're addressing some of these capabilities and offerings in a slightly different lens that paves the way for not just today, but for the next few years to come. So that's one point number one. I do believe that the people retention and the attrition challenge will continue for the next 2-3 quarters. Like I said, we're seeing stabilization on our end, at least when it comes to quarter on quarter, and we believe that will continue to get better in the coming quarters as well. But as it relates to people, the one challenge which frankly the industry has is the gap between demand and supply mismatch. And when I see that, customers have significantly started to look at how they're going to transform and how, in some cases, they're catching up, in some cases, they're accelerating. And because of this, the type of skills, what we call as future skills, that is expected in each engagement is very different from what it was even 2-3 years back, right? So our engine and ability to not just recruit, but cross-skill and cross-train is going to be even more important. Now, fortunately, we've had a very strong record with our services and cloud business already. We have now taken that across the company and implemented it across the key big bet areas that we focused on. So if you ask me, of course, there are challenges when it comes to the macro environment and political risks and specific geographies. There's always going to be some element of risks on M&A. But if we are able to address these two areas around service capability differentiation and people and getting them ready for future skills, I think we have all the ingredients as Mastek to deliver on the promise. So we're very confident going into the next fiscal year, given our pipeline and order book that we've been able to demonstrate. But these are the two areas that we've been trying to strengthen over the last few months.
Very quickly to add, Sunil, as you asked for demand, employee cost, the attrition, as I mentioned earlier, yes, there's an attrition which the industry itself is facing. We are doing multiple initiatives, as Siddharth alluded to, in terms of retention strategies. And we are ramping up our capability to hire people as we onboarded significant count of people this quarter, and we continue to increase the count as we are growing our revenue. However, yes, the cost, we believe there is a pressure to the cost, but there are multiple operating levers where we work for. There could be dilution in margin, but not significant as we expect, as operating levers is going to offset some of the cost increase, and some of the cost increase we should be easily pass it over to the clients as well. Thank you.
Thank you. The next question is from the line of Amar Maurya from AlfAccurate Advisors. Please go ahead.
Yeah. Am I audible?
Yes, you are audible. Please go ahead.
So thanks a lot for the opportunity. So Hiral, my question is more to understand, as you indicated that, we had won a pretty integrated deal in a US geography. So how basically, going forward in next 12 to 18 months, so overall deal pipeline is going to build up in US. That is number one. Number two, Arun, if you can also indicate that, in terms of your 12-month order book, what would be like, the increase in the order book from the US geography, if you can split it, this order book into the US and others. These are two questions.
So let me take the first, and then Arun, if you want to take the second. So, Aman, the pipeline that we have today is actually the highest we've had, and part of it is related to the larger deal sizes and so the larger customers that we're engaging in. Having said that, just to stress again, the order book that we had in North America last quarter in Q3 was the strongest, and as we look at the deal pipeline in terms of not just the size of the deals, but the type of deals, right? Whether it's end-to-end process transformation, whether it's cloud SaaS managed services, whether it is integrated deals in terms of the types of technologies. It's not just in one or two areas, or we talked about the deal which had Salesforce and Oracle, but there are technologies that we are seeing. There are deals with ServiceNow, for example, or Snowflake. So we are seeing different types of deals, but our value proposition that we're taking to the customers in the US is starting to resonate. because we have an integrated proposition around D2X, but we have now expanded that to certain process areas. The example I gave on lead to cash order transformation is one such example. But we look at that industry by industry, we have an opportunity to differentiate. So pipeline-wise, we expect Americas to continue to grow fairly significantly and in a differentiated manner. The people and the hiring that we have done, even including some heavy hitters and experienced people coming from the industry, will also support that growth. And you should see continued traction when it comes to not just pipeline but order book as well as revenue in the Americas. Arun, if you want to take the second one.
Yeah, very quickly, again, we don't give breakup geography-wise, but quickly, it's in the range of 7 to 8% increase in 12 months order backlog quarter-on-quarter.
My context is when you say that the large deal pipelines or large size deal pipeline in US. So the quantum of or the size which we are we recently won in UK, probably larger size, kind of a $60 million or $40 million. So those kind of deals are also in the pipeline or in the discussion in US?
Let me clarify that. I mean, it's a good point. When we say large deals in the US, I gave this context, I think, in the last call and some of the questions as well. Historically, our deal sizes in the US, if you rewind back maybe about a year and a half, were in the 500K range. Right? If you really go back in 2020, a large deal in the US market for Mastek was 500K. So in that context, the point I want to stress on is, compared to some of the larger framework deals and the larger opportunities in public sector and health sector in UK, that is not a comparable size for the Americas. Having said that, our deal sizes in the US it's starting to see deal sizes in the $5 to $10 million range, right? Which we had not seen 6 to 9 months back. And that's really what's giving us confidence, because that's very different from the type of deals that we've seen in the last 2 years. And many of them are integrated deals, many of them are managed services deals, and many of them are combination deals across multiple technologies. So that's the range that I'm referring to, in the $5 to $10 million range.
Oh, thanks a lot. And best of luck for the future.
Thank you. The next question is from the line of Sahil from SS Capital. Please go ahead.
Hi, sir. One thing I wanted to understand, the major focus of our strategy has been Oracle Cloud and ERP. Is there any focus, or could there be any focus on, diversifying the set of cloud providers we work with? Because, for example, Azure, AWS, Google Cloud are all hyperscalers, and being in those value chains might allow us to grab a larger share of customer wallet.
Yes, absolutely. First of all, the Oracle business led by Umang and team have done a fantastic job. Our focus on that is really helping. Like I mentioned, we're the only company listed on Oracle's website where we're able to effectively compete. So that advantage and that differentiation we want to maintain. Having said that, absolutely, the 3 platforms that you mentioned, or a couple of platforms you mentioned, and then also a couple that I mentioned earlier. So part of our strategy is also to look at Microsoft, not just Azure, definitely Azure and related hyperscalers, but also Microsoft as a whole, where we are seeing some good traction in the Power Automate around the business intelligence, around Azure DevOps. Salesforce is another platform that we're very bullish on. The win that we had is giving us confidence that we can build pipeline in that space as well. ServiceNow is another area that we've started getting traction in particular geographies, particularly in Middle East. We can take that to the UK and Europe and US markets as well. And AWS, we're seeing some really good traction in UK. So we're being very selective also in terms of which platforms and which cloud solutions to bet on. But Azure and AWS are definitely part of the strategy. And Salesforce, UiPath, and ServiceNow definitely part of the strategy. We are not planning to build any capability in SAP. We are not planning to build any capability in any competing direct to Oracle ERP providers. But these platforms that I talked about are all complementary, and we are seeing that in the same accounts that we are already in. And that's really what I was referring to in the capability build as well. We focused on these 4 or 5 platforms, and you'll start seeing more deals in that space as well.
That's great. If at all possible, I would suggest, if possible, to please break down, any kind of revenue, like how much of it comes at all from these other platforms, because that helps us understand sort of the diversification of the revenue stream. The second question I have for you is, if you look at our attrition rate at 28%, it's possibly one of the highest that we have seen among listed peers. And I'm just trying to understand, when I compare to some of the peers, this is fairly high. And is there any reason for that? Why our attrition, and even pre-COVID, it used to be fairly high at around 20% or so.
Arun, correct me if I'm wrong. I mean, if you want to add, but I think our attrition number is 7%, 7.1%, and that's the same number, or in that range is where we were in Q2. So, the comment that I had made earlier in terms of quarter-on-quarter stabilization was related to the range of that percentage points. Now, having said that, it is high, and clearly there is increased focus on that. We do believe that in the last 3-4 months, our HR and people experience team have done a phenomenal job, and we are seeing early signs of that stabilization, like I mentioned. It's not going to come down to pre-COVID levels or levels from last 2 years, but we do believe that we'll get a lot more aligned with industry standards as it relates to attrition. At the same time, we focused and increased our efforts on recruiting, both in freshers and laterals. So that combination effect is giving us that confidence about catering to the demand that's in front of us. But yeah, I mean, I think there is a slightly higher percentage compared to the industry when it comes to our numbers, and we do plan to bring that back in line.
And then,
if you want to add anything.
Yeah, and as Hiral mentioned, we are seeing quarter-to-quarter attrition quite flat. There's an early sign of recovery at the scaling curve of the quarter. However, when you're seeing the 12 months LTM which we report, which includes quarter of last year as well, where the attrition was not that high, was pretty low, the lower single digit, which is causing quarter-on-quarter LTM numbers to look high. But as a confidence which we are getting internally is with a lot of initiative which has been taken up as a retention strategy. The whole HR and PXC team is working on that. The recruitment team is working into multiple directions, breaking up hiring, offer to joining ratio to all other levers to ensure people join and not much of the decline is happening. So it's a multiple intervention which has been done at the company level, and we feel more comfortable that attrition is stabilizing, and definitely need to do a lot as a focus to ensure we keep reducing this attrition percentage to drive the growth.
Thank you. The next question is from the line of Zuberi from Mondrian Investment Partners. Please go ahead.
Hi. Thank you very much for your time. A couple of questions from my side. The client additions have been somewhat softer compared to a few quarters. So do you want to understand if that is a step change in terms of the different strategy where you will be more focused in terms of the clients you pick upon? And second would be on the on-site offshore mix. So although the mix has remained pretty stable, the absolute growth on the on-site has been a bit more. Do you want to understand if that is something which is more sustainable and this is what would be going forward, or is it on the back of a new project that you've taken on? Thanks.
Sure. Arun, why don't you start with the second part, and then I'll cover the first on the client side.
Sure. Very quickly, in terms of onshore offshore mix, the kind of account you are seeing is quite in the range from last couple of quarters. We believe the ratio is going to remain range bound. There could be 100-200 bits improvement which may happen as you grow more of the private sector business, because the public sector is primarily focused on the onshore headcount. Some of them, yes, have offshore opportunity as well. But as we grow our private sector a lot in terms of integrated solutioning and other strategy, we are talking about US, we are talking about Europe and other geography. We believe this ratio may improve, but not significantly. We believe 100 to 200, this could be a good range. Hiral, over to you for the client addition part.
Yeah, I think we answered that earlier, but if you can clarify the question once more, because I think our client base is fairly high compared to most of our competitors, and we have taken a focused strategy on larger clients as well as higher quality revenue within the existing clients. So to some extent it is by design, and to some extent it is our improved ability to engage with Fortune 1000 and Fortune 500 customers. I know we talk about Fortune 1000 as a whole, but interestingly, we've had actually a couple of wins in Q3, which are with Fortune 500 customers, and these are actually very large global clients as well. One of them in particular is in the consumer and CPG space, which is a very large client and also has the ability for us to deliver multiple services and multiple service offerings to them. So the nature of our discussions, the size of our deals, the impact that we're able to make in our existing customers is starting to improve. This goes back to our account mining and client mining efforts, which we've talked about in the past. So we're not necessarily that focused on purely the number of clients that we are adding, while that is an important part of our strategy, but we would prefer to go much deeper in our existing client base, and we're seeing the potential to do that with our client base as well. So hopefully that addresses your question.
Today, does this answer your question? Thank you. It seems there's no response from the line. We will move to the next participant. That is from the line of Lisa from Equentis. Please go ahead.
Hi, thank you for the opportunity. It's relating to the order size. Actually, the industry is moving towards, smaller size deals because the revenue generation is faster in that sense. So I wanted to ask about your strategy of moving to larger deals. And also I wanted to understand the range of deals that you all are, targeting. What will be the range of the larger deals?
Sure. So, Lisa, it's a good point when it comes to the digital engineering work that we do. A lot of the customers are looking at smaller deals in terms of not just the size, but the term of the contract as well. And we continue to have that type of business when it comes to what we call as land and expand, which is, starting with a particular point in place and then expanding to other areas. And in the particular specific deals might not be that large, but over a period of time it does add up. Now, having said that, the profile of the deals that we've had historically, particularly in the Americas, have been much smaller. Like I mentioned, 2 years back, 500K was a large deal, right? So now we are starting to see that $5 million, $10 million deals. So I'm talking about that range of deals, which may not be large deals for some of our competitors, but I think in our case it's a significant, higher profile of deals that we're seeing in the US market. When it comes to UK, what we call large deal is anything above a $25 million deal. And we see a lot of mid-sized deals in the 10, 15, $20 million ranges in terms of 3-year deals. But also our ability now to compete in those 25, 30 million plus deals has significantly improved. And this is based on credibility and work we've delivered. I mean, keeping in mind that our customer satisfaction index and credibility of our go-lives, we've had about 60 customer go-lives and releases in Q3. Right? Some of them have been small, some of them have been large. But the point is that there has been no escalation, there has been no downtime, and that is giving us the ability to compete in some of these larger deals. So I would say about 30 million, about 25 million would be a large deal in UK, and about 5 million would be a significant deal in the US market. So hopefully that addresses your question.
Yeah, that was helpful. And also another question was about Are you facing any challenges in the next quarter? Like, do you see any challenges in US or UK business, the orders closure?
Can you clarify that? Challenges in terms of order closure?
Like you all had the seasonality issues in Q2 and Q3, right? In Q3, I think it was related to COVID. In Q3, it was because of the seasonality issues. There were deal slippages. But do you see that in Q4?
Sure. So Q3 was a good order booking quarter for us from a deal momentum perspective, even though typically, the last week, 10 days in December is a little bit tricky with the holidays, but, our teams did a phenomenal job in stepping up and closing some large orders even in December. Now, having said that, the larger deals that I was referring to typically do take slightly longer cycles, and some of them are more competitive. The large logistics company and trucking carrier deal that we won actually has had competition which is significantly bigger than us, not just the tier one Indian IT services companies, but even large MNCs that you probably recognize. So we've been able to beat some of the larger competition. And in deals like that, right, it's going to take a longer process. It's a much more rigorous process. So that's the only thing I would add, saying that, some of these more strategic and larger deals are taking a little bit longer in terms of the competitive life cycle. But otherwise, we don't see any seasonality or any such thing in Q4 or Q1 going forward.
Thank you. Before we take the next question, participants are requested to limit their question to one per participant. Thank you. The next question is on the line of Ashish Dash from Sharekhan by BNP Paribas. Please go ahead.
Thanks for the opportunity. Hope I am audible. My question is on margin. Arun, you mentioned that there could be some downside in the margin. Why I am asking, this quarter there was no wage hike. So in Q2 it had 200 basis impact. Still we are delivering a flat margin, and I can see there are strong growth in data and cloud businesses. So it's basically high margin businesses. So when you say downside not significant, could you please give the outlook of margin? What kind of downside you are expecting in FY20? Earlier you used to mention that high teens. So is it that kind of margin you are expecting?
Yeah, Ashish, when I'm talking about downside, I'm talking in the range of 1,500 bips, not more than that. And that too, more to led by, if, some wages are going up, some you will be able to pass on to customers, some still you have to bear. At the same time, you are working on operating levers. There could be certain timing gap in terms of improvement in the timing of the cost which is coming on. We believe, we are roughly in the range of 21% margin profile. We are comfortable, any reduction in the range of 50 to 100 bits maximum. Otherwise, we don't see any more impact at least in short term.
Okay, got it. Thank you so much. That's all from me.
Thank you. The next question is from the line of Sameer Pardikar from ICICI Direct. Please go ahead.
Yes, sir. Thank you for the opportunity. So what is a rough mix about in UK market about government and the private?
Hello? Arun, wait to get the question. I couldn't get the question fully. Yeah.
See, roughly. So broadly it will be 70-30% kind of a ratio. Well, we don't share exact percentage, Sameer, but broadly 70-30 kind of a ratio. 70% will be public sector and 30% will be private sector.
Okay. Thank you. And I think last quarter you talked about around 25 to 30 deals in the pipeline. So how much deals are already closed and how much deals that we are basically looking going forward? Any update on the deals over there, which you mentioned the last quarter?
Yeah, I think some of that, Sameer, you're seeing that reflect in the Q3 results as well, with the order book backlog as well as the increased activity in terms of deal closures. We continue to build on that pipeline. So obviously since we spoke last and since the last quarter, call, we've added more deals in the pipeline as well. Many of them have closed, and many of them are slated to close in this current quarter. So that pipeline is obviously a continuous process. You can expect a few more significant deals in this current quarter as well. And that is again across UK as well as Americas in the ranges that I was referring to earlier. So.
Okay. And regarding this Middle East, our strategy about only few clients and more quality kind of a revenue. So what is the thought process behind this? Is it a geopolitical risk is there, or what is basically stopping us to go for a larger number of deals over there?
No, so maybe I can clarify that a little bit. So we are actually seeing increased deal activity even in Middle East. The point that I was trying to emphasize on is that the nature of the new clients that we're able to engage are now slightly larger clients, where we believe that there's a much more longer and downstream view of the mining that we can do with those clients, right? Second is, in our existing clients, about 50% of our existing clients we feel are great candidates for cross-sell and co-sell in terms of integrated value propositions. In fact, we moved a senior person from India to Middle East who's going to be focused this purely on this activity, on cross-sell and digital services in the Middle East. So the broader strategy there is that because we're seeing increased engagement with larger clients, as well as our ability to mine better in certain segment of clients, it doesn't make sense to go after every single deal. So we have a focus strategy on certain verticals and growing certain accounts where we now have delivery managers and account manager clusters of them for specific accounts that we feel can become much larger. So over a period of time, that will do two things. The number of clients, purely in terms of quantity of number of clients, will reduce. The quality of the revenue and the margins will improve. And the account size, in terms of the revenue coming from an individual account on an average, will increase as well. So we believe that's a better profile when it comes to the Middle East business, which positions us competitively. And we have a fairly good market share out there. So we have some good credibility and case studies to increase our wallet share with some of our existing customers as well. So that's really the overall strategy.
Thank you. The next question is from the line of Mohammed Patel from Care Portfolio Managers. Please go ahead.
Yeah, hi. My first question is, in the presentation slide number 14, so you have mentioned revenue by contract type. So the fixed price proportion has increased from 45 in Q2 to 49% in Q3. Is this the reason for the impact of top line in Q3?
Go ahead. Can you speak quickly again? Are you talking about fixed price engagement from 45 to 49?
Fixed price proportion revenue has increased from 45% in Q2 to 49% in Q3.
Yeah.
So I just wanted to understand if this is the reason for the slow growth in Q3.
No, I will not. Basically, that's not the may not be the right relation of this factor, because we have a both kind of engagement with our customers where we go and talk about the outcome. Even a lot of T&M contracts are also based on the outcome, while fixed bids are definitely outcome oriented. And the margin profiles are quite similar as well. The growth profile which we are getting both in terms of fixed bid and T&M in terms of contract engagements also moving in the same direction. So I will, maybe that reflection may not be right to count.
Okay.
So Arun, if I can just clarify and add that, I think it's a good point when it comes to tying back to our strategy though. We do have an intent to do more fixed price projects and also more projects based on business outcomes. We believe that's differentiated us in terms of winning deals. We have the value-based delivery model that we had from our Oracle Cloud business, which we are now adopting across Mastek. And that ability will give us more predictability of revenue and the ability to deliver on those fixed price projects. I talked about some of the go lives and releases that we've had is getting much stronger. So to some extent, in terms of immediate near-term conversion, it might have had a slight impact because the time and materials business has reduced a little bit. But it is part of our strategy to do more fixed price projects and more business outcome-based delivery. And, that potentially might be even higher in the coming quarters, but that's part of our design of longer-term engagements as well.
Okay, that is helpful. My second question is that this performance-linked incentive to Evosys management, so how much transfer is left?
You're talking about the CCPS buyout?
Yes.
So at the moment we are about 10%, which is going through all the approvals in place, and the whole transfer of the cash and the issuance of equity will complete in the month of January. Balance 20% will be buying out in equal tranches in quarter 3 of next year, or we can say calendar year 2022, but quarter 3, and similar time in the next year as well.
Okay, that's helpful. That's it from my side.
Thank you. The next question is from the line of Vaibhav Barjatia from HNI Investment.
Yeah, hi sir. Thanks for providing the opportunity. I just have one question. So how much, I just wanted to understand what kind of impact pound fluctuation can have on our bottom line. I understand that most of the public sector revenue, the costs are also pound denominated. But what's in terms on the revenue side, under the government contracts, is there any clause where we need to pass on some of the fluctuation, or it is just fully upon us?
All the currency risks belong to the company. The contractings are more in terms of services we deliver. The pricing is done keeping certain currency, fluctuation in the mind, so that if the currency fluctuation comes, we can take care of it. Secondly, what we do, we have a hedging strategy as well. One, there is a natural hedging. Wherever you are serving onshore, there is an onshore cost as well. So you get the natural hedging from that perspective. And whatever you are bringing back to India because of the offshore delivery, there is a hedging which is available. And we as a company keep very active to ensure the pricing which we have factored into the deals with a certain rates in place. We try to cover at least, by keeping that rate in the mind in the forward market.
Right. And that natural hedge would be in the range of 60-70% of the revenue, or it would be lower?
It's a similar range. Like, if you are seeing the headcount split gives you the kind of range between onshore and offshore.
Thank you. The next question is from the line of Baidik Sarkar from Unifi Capital. Please go ahead.
Yeah, hi. Thanks again. I understand the ramp downs in UK, might have been there in the previous quarter, and given the impact of the fifth wave as well. Given the NHS win today and the ramp of negatives that will come from the closure of other smaller projects, do you reckon we will get back into sequential growth territory starting Q4 itself?
Yes, the answer is yes.
Sure. And, congrats on crossing the $100 million annualized threshold in Evosys. What is the annuity versus project split here? And importantly, Larry's been talking about a 20 billion run rate by FY26 for the cloud and ERP projects of Oracle. How does that shape your imagination of how your practice line will play out by then?
Yeah, so, I think our strategic nature of partnership and the differentiation that we provide in Oracle cloud space has even gotten better. As you know, they announced, in addition to, of course, the overall cloud uptick in revenue, they announced a fairly big acquisition in Cerner. And interestingly, Evosys, with some of the history in healthcare, had done some work and has been doing some work in integrating Cerner with Oracle. So this puts us in a very unique position because our focus on healthcare and life sciences and our ability now to look at Oracle cloud in a much bigger way, which includes Cerner, is also becoming interesting. Some of the deals that I was talking about earlier, which is the front office to back office, now can even be amplified as we start looking at even platforms like Cerner, which become part of the core engine that drives payers and providers. So, all in all, Oracle is bringing us to a lot more larger deals and larger clients. The overall uptick in cloud revenue of Oracle, we don't see any stopping, at least in the foreseeable 2 to 3 years. The market is still pretty high on that growth because some customers are still starting that journey. We are actually gonna continue to feel bullish about that space. And the Cerner acquisition recently has given us even more confidence to differentiate in the healthcare space.
So that's helpful. Would you have the annuity versus project split handy? With any business?
Very quickly, let me try it out. In the Oracle part of business, our managed services would be closer to 30%, and closer to 70% would be kind of implementation business.
So, and how much of your $170 million order book today is the UK private sector?
Baidik, again, we don't provide the breakup, but as I mentioned earlier, our UK business would be 70-30 split in terms of public and private.
That's helpful. That's right. Okay.
Thank you. Our next question is from the line of Madhur, as an individual investor. Please go ahead.
Hi, thank you for the opportunity. I have 2 questions. One is related to the cloud solution that you mentioned that you are looking for supplementary cloud solutions as well. So, are you looking for developing these capabilities through M&As or organically? The second one is, are we doing any work in terms of cloud security solutions as from other peers that we understand is that there is a high demand of cloud security solutions as of now. So if you could explain that as well.
Sure. So let me answer the second question first and then I'll come back to the first. So cloud security in many cases is starting to get embedded as part of our discussions and engagements. In fact, one of the deals that we won and a couple that we are delivering are in areas what we call as DevSecOps. And what this really means is security is embedded in part of the application lifecycle and delivery that we're doing in terms of modernizing, in terms of operating and moving them to the cloud. So that work we are already doing. We have the capabilities and the experience to do that. Now, having said that, we don't necessarily focus on the security areas, very exclusively. And there we're taking a partner-based approach. We have ongoing discussions with 2 or 3 different cybersecurity companies, and we believe that this is a good area for us to partner when it comes to deeper cloud security capabilities that can add on to our digital engineering and cloud transformation practices. The first question, I think I partly answered, but just to kind of quickly address it, the areas around Azure and AWS, we have in-house and organic build activities ongoing. So we're keeping an eye out for inorganic and M&A as well in those areas. And the same holds good for the data automation space and the CX areas.
Okay, thank you. Thank you so much.
Thank you. Next question is from the line of Parag Dharande as an individual investor. Please go ahead.
Yeah, hi. Can you hear me?
Yes, we can hear you. Please go ahead.
Yes.
Yeah. Can you elaborate a bit more on your capital allocation framework? So, for example, how much you would like to give as a dividend and how much you want to retain. And the second thing is, the float in the market is very low. So, if there are buyers, the share goes high. If the sellers, share go down. And this has been a historic thing with Mastek. So have you thought about bringing in more stability price in terms of by say increasing number of share, by giving bonus or increasing split? Yeah, thank you.
Thanks, Parag, for the question. In terms of capital allocation, we have been giving dividend in form of interim and the final dividend. We believe that process will continue. And as a part of capital allocation, as we mentioned about the M&A activity, we believe there's a very good potential for us to keep growing. And as a combination of the strategy, some portion of the growth should come through the organic investment, some will come through partner model, and some through M&A. So it's pretty the allocation which is required to meet the Vision 2025, and accordingly we will be allocating the capital. But our intention is to maintain the dividend run rate, which we are running currently. In terms of float, very very valid point for us. Yes, we do see the similar pattern. Since the float is low, as soon as significant buyer comes in, the prices start fluctuating significantly. However, there is no current plan as such for the bonus issue, because that depends a lot with the other strategies, including what you have in the reserves, how you can allocate, and so on and so forth, including a lot of board level discussion. But definitely we are keeping this on our mind, and as we move on and as we finalize the strategy to take further action on it, we'll intimate all of you.
Thank you. The next question is from the line of Utkarsh Samaya as an individual investor. Please go ahead.
Thank you. My questions have been answered.
Thank you. We have the follow-up question from the line of Manoj Baheti from Carnelian Capital. Please go ahead.
Hi. Thanks for taking my question again. Just a long-term strategic question to you. You mentioned that there is a transition which is happening from one-time implementation to managed services, and you are also aggressively working on that. So on this, two things, if you can give some color, that how you are building the capability, talent, what are the things you are doing for this kind of transition, and if you can give some broader picture that in next 3 years, say by 2025, what is your vision if I see a revenue pie of your company between like one-time implementation and managed services, that would be really helpful.
Okay. So, Manoj, I think this is a good, I believe this is the last question, but so it's a good way to end with the 3-year strategy and some of the strategic bets and priorities that we put together. So when we look at that example that I gave, which was actually a healthcare provider, in the past, when it comes to the cloud implementation business, what we had was we used to do the implementation, and typically, in most cases, our project ended and our engagement with the customer ended, right? Mm-hmm. Clearly, that was working to some extent because we went on to the next implementation and then we went on to the third implementation, right? So in different customers, and that's why you see a larger number of clients as well. What we've now been able to do is put a bit of a more account-focused strategy. And this does not just apply to managed services, but it's basically looking at customers for life and looking at account mining and the typical client partner strategy used to grow these accounts. So the example that I gave you was a classic one, and we have a few more like those globally, where the implementation was very successful. Actually, it was a very aggressive 6 to 7 month implementation, which the customers themselves were not very sure if we would be able to deliver, but we actually delivered on it and we went live a couple of weeks back. But on top of that, we started to frame up how we would transform their IT landscape, how we would look at not just supporting their applications in the cloud and the digital landscape, but how we would provide certain additional innovation on top of that. Because moving to the cloud is just one part of the journey, right? The real value, and that's the reason why we feel we're in a unique position, is because almost 50% of our customers have moved to the cloud in some fashion. And now they're starting to look at the cloud economics and look at how will they innovate and how will they create differentiation for their customers, meaning our customers' customers. So that's where we are playing in, and managed services is just one step towards that. Clearly, it requires a different type of skills and talent building, which we have done over the last few months. So this is not a new initiative as such, but we've strengthened our ability to do that. driving is definitely a key part of our overall 3-year strategy as well, where we look at larger accounts in terms of the lifetime value that we get from the customer and the value we are delivering to the customer as well, right? Not stopping at a particular project. It could be a cloud implementation or a digital engineering project or an e-commerce project, but looking at it in multiple surround areas and building our presence and wallet shares around surround areas within that customer as well. So that is one. Second is, our overall managed services business is probably going to go higher in the next few quarters, and you'll see that reflected. There is no specific target that we have, but we believe we can take it to 40 to 45% of our overall business, which gives us a lot more predictability and annuity revenue. And that would be a good place to be in addition to what we do from a digital engineering and a cloud transformation perspective, because we do see that there is going to be lot more investments in data, in automation, in specific areas around industry clouds. So some of that will still be project-based, and we have a fairly solid project-based DNA in our ability to close and engage, whether it's cloud projects or digital projects. When we look at 2 or 3 other levers and take a 3-year view, there is the industry vertical focus that we talked about, and I know we've talked a lot about healthcare and life sciences, but we're seeing some really good traction in manufacturing-centric clients as well. This is where the industrial manufacturing, even the engineering and construction kind of companies come into play. We've also seen some initial signs of specific financial services customers where we've been able to differentiate. So, our ability to be very industry specific in our differentiation and engagement is an important part of our strategy as well. A lot of these platform companies, whether it's Microsoft or Salesforce or ServiceNow or Snowflake or even Oracle and others, have started to invest in industry clouds. And to us, that's a very positive sign because it really aligns well with the strategy that we've been using to go deep into the industry. So, those are some of the elements that we have as part of our 2025 vision. And some of that is in motion right now. And of course, we're going to amplify many of them in the coming quarters. So hopefully that addresses your question as well, Manoj.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
All right. So I think so it's a longer session than expected, but just a fantastic set of questions. I think, on behalf of Arun and Mashank as well, I'm sure we've really enjoyed the interaction. I do want to reiterate that our people are our most important asset, and our customers have always been the focus for us. So we will not deviate from those 2 principles because doing the right thing for the customer and delivering well on time, which is what we've done, and taking care of our people is really what's going to position us better in the future. We want to really thank our investors and all the analysts in the call as well for your support and trust. As you would have seen, Mastek logo has been updated with 3 words which go hand in hand with what we've done and what we do: trust, value, and velocity. And we're going to be living each of those in every single stakeholder. So whether it's customers, whether it's our society, our employees, our investors, our heritage is based on trust. Our focus is going to continue to be based on delivering value, whether it's business value, whether it's career value for employees, whether it's social value in our society. And we are very confident that our entire leadership team and the entire Mastek force of 4,800 people have come together really well in these challenging times. And we're looking forward to more exciting times ahead. I know there's still a lot of variant and pandemic around us, and I really wish everyone all the best and stay safe. We will continue to be transparent and share more details as we make progress. And again, thank you for all the questions.
Thank you very much. Ladies and gentlemen, on behalf of Mastek Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.